Good morning, everyone. Anthony Iser here with another ITPM Flash. Well, it's Wednesday morning, 21st of August, and I'm going to be looking at AI. Now, on one hand, it feels like AI has been done to death. On the other hand, there's still plenty of opportunities out there. And we've been trawling through the theme in the sector. I've run recent webinars on how to find AI-related ideas. Our Discord channels have been full of competitions looking for AI-related ideas. There's still huge opportunities there. And today I want to talk about a laggard in the sector, in a sector that's grown incredibly well. We've got a stock that's recently listed and halved in share price since that list. The stock is Astera Labs. The ticker is ALAB. And as you can see here, it's been a big underperformer since its listing in April. I'll explain why I think that's been the case, why I think that's coming to an end. But first, what do? Well, I'll keep it simple because they are right at the pointy end of AI-related tech. But they're the number one player in the retimer market. And essentially what they do, in a world of GPU servers where speed and power is the most important thing, their little bits of tech unblock the bottleneck. Now, NVIDIA is the biggest customer, but they also have a well-known range of customers. Microsoft, Amazon, Google, Meta, AMD, you name it, they are customers. Anyone who is looking to build AI quality GPUs is a customer of ALAB. Now, the most important thing, and looking at the quantitative side of things first, is how have their numbers been doing, and how does that relate to this decline in share price? Again, I'll get to the decline and the reasons for it, but it's important to note that this new listing was $36 when it came on, opened up at 70 or 80, got to 95 and is back down to under 40 as we speak. So it's been a big decline, but despite that, the numbers have been good. And the numbers have just come out for the last quarter. Revenue growth, 18% quarter on quarter, 600% growth revenue line year on year. R&D, as you would expect for a company like this, huge portion of their revenue. R&D expense more than 50% of their revenue. This result has seen the market lift their forecasts on the back of higher guidance from the company. So you can see here, EPS upgrades of 20 to 50% have come through in the last week or so since this result has come out. So we're now seeing 40% plus revenue growth, 40% plus EPS growth for the next couple of years. And I would argue a pretty good chance of surprising on the upside. Now, any of my mentees or people in our Discord channels, and probably you at home, would know that I'm very focused on revenue growth. I'm very focused on knowing what the drivers are. Revenue simply is price times volume. Doesn't matter whether you're selling hamburgers at McDonald's, t-shirts at Lululemon, or retimers into the server market. And the first thing that I note with ALAB is that their average selling price is going up. Well, as they move up the curve in terms of complexity, they're able to get higher prices, higher margins. That might not be sustainable the whole way through. 78% gross margins now. Good chance that drifts back a little bit lower in the coming quarters. But that average selling price is continuing to increase. So they're launching new products. They're increasingly sophisticated. And prices are going up. Additionally, volumes are going up. Now, there's three key ways you can get increased volumes. You can maintain your market share, and the pie can grow. And we know the AI pie is growing. Now, within that, their piece of the pie is also growing. One of the risks is their customer, NVIDIA, their biggest customer, and I'll talk to that in just a moment. But their share of the pie is growing because they're adding new customers. All of the big hyperscalers are looking to create their own products, their own GPU servers to power their AI development rather than depending on NVIDIA. And all of those players, names I mentioned before, are all customers. So they're expanding their pie on that front. Additionally, they're taking their products that are at the very pointy end of things and bringing them down the chain to regular servers, regular networks that need help in running a little faster. So the way I think about this is thinking about something that was really pointy end that then became mainstream. So think of airbags. When airbags were first developed only in super luxury cars, maybe in the steering wheel, and that's it. As time has gone by, technology has got better. You've now got airbags all throughout the car, and it doesn't matter whether it's a Rolls Royce or a cheap Chinese car. They all have airbags now. I think that's what's going to happen with this retimer market over time. Instead of just being focused very much at the pointy end on the GPU market, where the higher margins are, they'll be able to drive it down and increase volume over time. So we've got new products, we've got new customers, and a growing market. All of that makes sense to me. Now, there's also risks, of course, and I've mentioned NVIDIA a couple of times. From the IPO, they were aware that NVIDIA, as NVIDIA moves up the tech curve, is going to need less retimers. And the latest GPU servers to come out in the coming year, they'll go from having 8 to 14 retimers in that server down to 1 or 2. But that volume is going to be made up elsewhere. It's going to be made up with other customers, and it's going to be made up with other NVIDIA customers and NVIDIA products coming through at the lower level. So more volume in the older servers as well. So I think it's been well flagged. It's one of the reasons why the share prices come down a little bit, but it's not the key one, I don't think. So you can see on this chart here, just after the IPO, the market had to downgrade earnings. To me, this is an error with the lead managers of the IPO, perhaps the company, but there's miscommunication through that IPO process. Nobody should be downgrading straight after an IPO process. The numbers should be on the conservative side and well known. So something's gone wrong there. I don't think it was an operational issue. I think it was just communication and management issue. And when the stock opens up and it's up 100% and you're an investor and then the company is downgrading when it's seeing the market downgrade, you're going to get out. And that's what everyone's done. So everyone's sold over the coming months, double the money, move on. We were buying this as a super growth company. Why am I getting downgrades? And that's been rolling through since April or May through to this period in time. Second thing is, as part of that process, all the analysts get gun shy. They've come out with price targets of $95 and suddenly they find it's 60. They're less inclined to be calling people and saying, no, we think this is right. We think our numbers are right, because they've had to go and sort of downgrade them. They've made a mistake already. So they're going to be playing catch up. They've got their tail between their legs and the stock goes off the radar a little bit. And the analysts basically need to sort of get their mojo back, get their confidence back, know that their forecasts are going to have a very good chance of coming to fruition. So that's a second factor. Third factor is that there was insider selling through this process as well. Standard practice, lots of companies that come to IPO have a lockup period. The performance of the share price was strong, more than double the IPO price. So there was early release of stock and there'd been ongoing selling. Now, on the back of this last result, you'll see here that the estimates are back to where they were at the start of the year. So I think these issues are fixed. But what we've seen with this share price decline is not an earnings issue because it's back to where it was, but now it's been entirely a multiple decline. You can see here at the peak, PE, it was around about 300 times when those downgrades came through. We're back to about 55, 60 times at the moment with a stock just under $40. So I think we're going to see two things over the coming months and mostly through into the next result. That seems to be the most likely catalyst. I think we're going to see earnings upgrades coming through. I think we'll see that multiple start to pick up again as people get comfortable with that growth. My price target's $70 for A-Lab. Now, how do we play it? Well, I'm looking at a trade structure that is very common for my setups, which is a ratio calendar. With this result, getting things back on track and those upgrades that I would expect to see come through, I think we need to look at the next result. So my comfort level is around the next result. There's no obvious catalyst between now and then. Doesn't mean the share price isn't going to move up, but I think I need to see that catalyst in that next result. So when I look at the options market though, the results in early November, there's no November contract and there's no December contract. So I'm going to have to go out to January 2025, further than I would like, but there's flexibility within that as well. So as I look at it now, the $40 January calls are $6.55 and the September $40 calls are $3.25. So if I do that in a 2-for-1 ratio and I put that trade on 10 times, my January outlay is going to be $13,100, $650 per contract, 20 contracts. The credit I get for September is going to be $3,250. So yeah, 325 times 10. So my total outlay, $9,850. Now, I said earlier my price target was $70. If it goes to $70 in September, which I don't expect it to, I don't see obvious catalysts, but lots of things can happen, then my profit would be roughly $48,000 for my January leg, maybe a little more, a little less, depending on what time values implied at that point in time. My loss on the September leg would be $26,750. So my total profit would be $21,250, or 215%, which I think is a great return over the next month, and particularly when that's not my ideal outcome. So that's an outcome, that I'm going to obviously be content with. But what I'm really looking for is the lack of news in the short term. See this stock trade sideways. I get that full credit for September, and then the share price can rally on the result and through unencumbered with my $40 calls. Now, I'm going to be talking about this trade quite a bit in our Discord channels because there's quite a few variations and possibilities that I can do from here, all of which are hypothetical. But if the September contract does drop out and I do get that credit, it expires worthless, I have up to 3 opportunities at least to get further credits, reducing my cost and massively increasing my risk and reward. So I'll be talking about those in real time as it plays out in our Discord channels. So if you're alumni and you've done some of our courses, you want to join the Discord channel, join up. There's lots of good things going in there, but in particular, I'm going to be talking about this trade. So I can pull that January contract back to November when the November contract comes on at the end of this month. That's one way I can get a credit. I can potentially write another October call and get another credit. And I can turn it into a vertical, possibly, depending on where things go, and get another credit. All of which reduces that entry cost of $9,850 down to a substantially smaller amount, but maintaining or increasing the possibility of a sizable return. So that risk ratio changing quite a lot. So in a sector that's gone crazy over the last 18 months, lots of stocks up 500-600%. I think Astera Lab, which is down from its all-time high, more than 50%. It's halved from 95 down to under 40. It's basically back towards its IPO price of $36. It's got strong growth, increasing customer base, increasing product line, and is now significantly more fairly valued. And those hiccups have passed us, I think. So I'm looking for this one to provide a pretty substantial return over the coming months. That November result being the key catalyst. Thanks again for listening. Anthony Iser, checking out.